Hi everyone, welcome to this live TV show. As usual, I'm going to share with you my views of the market, both technically and fundamental, for this week. And of course, a really exciting week, guys. I will share the calendar with you. Give me a second. It's a really exciting week, I'm saying, because as you know, we have the Fed policy meeting tomorrow. This is the last meeting of a year. The Fed has promised back in 2015 four rate hikes for this year, sort of promise, in fact, right? But we only got one. And over the past couple of months, not only data has been supportive for a rate hike, but also policymakers have been jawboning about rising rates and the need of rising rates, and uh, mostly preparing the market for a December hike. So according to markets analysts of odds, we have 25% odds that the Fed will rise rates tomorrow, from current 0.25 to 0.50% to a new floating target of 0.50 to 0.75%. Uh, and as this largely understood, this has been already mostly priced in the greenback, right? Nevertheless, we have the ECB last week. We gave a bad blow to the euro. The common currency plummeted back towards the yellow. We have a deal with between OPEC and non-OPEC countries over the weekend that sent oil to its highest levels in a year and a half. That harm a bit the greenback, but mostly what we are seeing this ever since the week starting, the dollar pulling back a bit. I do believe it's some profit taking and position adjustment ahead of the Fed. The fact is that the big question for tomorrow is not if the Fed will rise or not. I do believe that they have to rise, because they will suffer in their credibility if they don't, will be much more larger than any economic effect at 0.25% rate hike could do to the economy. You know what I mean? Anyway, the big question, as I was saying, is what the Fed will do next and at what pace rates will rise next year. The fact is that we have a new elected president in the US that will take the office by the end of January, if I'm not wrong, January 20, right? And he has promised high investment in infrastructure, tax cuts, all of which points to a fast pace of growth next year in the US. And of course, these measures are usually understood as inflationary ones, right? So somehow investors are waiting for a faster pace of hikes during next 2015. Although, for what I have been reading ahead of this coverage, the fact is that the market is not really pricing in much more than two rate hikes at this point. I do believe it's quite logical, because I'm not expecting Yellen to be extremely hawkish tomorrow. In fact, I would expect her to give the usual unclear jawboning of yes but no, because policymakers will likely wait until Trump actually takes the office and starts announcing its policy and economic measures, right? The market is talking about 100 days. We are talking about the first 3 months of government to actually see what is going to be materialized, from what it has been promised, right? That happens with politicians all over the world. So anyway, keep in mind also that we have a press conference tomorrow and a new dot plot. And if it's overall hawkish, and despite what I have said, that the rate hike is already priced in the greenback, if we have a hawkish stance, let's say, we are going to see further dollar gains, right? I do believe that it's clear that the euro and the yen are the weakest currencies these days, alongside with gold, right? So that would probably suffer the most. There's a really tiny chance that the Fed remains on hold, but as tiny the chance it is, As huge it will be market's reaction because the market will be extremely disappointed. Dollar sell-off would be huge after that event, and we can see the euro, I don't know, 110, 112, sort of the spikes we have after the election. Not saying that it will hold to such gains, right? But indeed, it will be a wild ride. So if the Fed stands on hold, I would say stay away of the market. Anyway, I'm sharing with you the macroeconomic calendar. We had little in the docket on Sunday and Monday. What I was watching particularly is that domestic corporate good prices in Japan, right, came in yearly basis minus 2.2%. This is a measure of inflation, right? And it has been negative for 20 consecutive months. Monthly basis, it rose by 0.4%. But overall, this is far, far away from the Bank of Japan 2% inflation target. Why also industrial data in Japan, sorry, has been quite disappointed with machinery orders, uh, yearly basis, industrial ratings, all really depressed. So I'm thinking that the Bank of Japan is still far away from its inflation target, as I said, and it will probably be forced to act again. But they are meeting in January. We are not having a meeting this December. So anyway, keep that in mind. This is keeping the Japanese yen weak, and will add uh, to the case of a bullish dollar Japanese yen if the Fed actually acts, right? Earlier today, we had, I do believe that the most important readings are still coming from China. Strong retail sales, strong industry and production. These ratings we have over the past 2 or 3 weeks coming from China have been quite encouraging, right? And it's poking the ghost of economic slowdown in China, and of course, fears of contagion all over the world. So it's pretty strong readings that uh, overall support optimism among investors. Sorry, I'm speaking faster than I'm thinking faster than I can speak. Okay. Anyway, today I believe that the numbers coming from the UK were not as good as we could expect, but still positive, right? Because we have an increase in retail sales, an increase in consumer inflation, and despite being below market expectations, producer prices were generally above previous month figures, right? So anyway, NADA in the UK, as we discussed last week, is not as strong as it has been past July, past the initial shock of Brexit shock. So overall, beware of pounds rally. Beware of the sudden reversal in the pound if we don't have strong macroeconomic figures supporting the ongoing rally. It's true, the pound is rallying on hopes for a softer Brexit after both the UK and the Euro area uh, don't talk the possibility of pushing the UK outside the single market, right? The doors are open for the British to stay within the market, maybe paying a close, making contribution, whatever you want to call it. The chance is there, and that will be a huge relief for the UK economy, and therefore the pound downward potential will remain limited. Okay. Anyway, we have not much to watch today in the US. Later today, there's minor reports. Tankan report in Japan for me, it's really interesting. As I said, Japan data can tell us whether the Bank of Japan will have or not to act next week. If we have poor ratings in here, we have more support for the dollar yen bullish case, right? Um, Again, data coming from China will probably be much more relevant than even for the Aussie than Australian data, right? Because they are sort of commercial partners. They're both in, in in the West, right? So everything that goes on in China affects Australia and New Zealand. So strong data in there should support the Aussie and the New Zealand dollar. Anyway, Wednesday we have a minor European data, nothing really relevant. In the UK, employment. This is usually a big market mover, particularly for pound is the UK non-farm payrolls. But this time, I'm feared that unless we have strong divergences between what the market is expecting and what the actual numbers said, we are not going to see a strong reaction to the data because the market will be waiting for Fed tomorrow. It's all about waiting for Fed. The same goes for industrial production in Europe. It's not a big market mover, but it's a barometer of the health of the euro area, and therefore the market will pay attention to it. It won't trade it, right? We will keep this in docket inside our minds for further trades after the dust settled after the Fed, okay? Retail sales and inflation in the US ahead of the Fed will probably trigger some modest spikes, right? But again, the market will be waiting for the Fed. Keep in mind that if numbers are uh, really positive, that will be further supportive of a Fed hike case. But anyway, the decision will be almost made by the Fed when this data is out. Of course, they have access to data, we don't. But keep that in mind. The market won't be paying much attention to anything tomorrow, but once that settles, right? On early Thursday, we have employment in Australia. Uh, if I'm not wrong, the last month was a big disappointment. Yeah, it was. It was sort of disappointing. If I'm not wrong, over the last Reserve Bank of Australia meeting, Governor Lowe expressed his concerns about employment, right? And he remarked that part-time employment is too high still, right? And they need more full-time employment. So keep on an eye on this report because today the market is thinking that the Reserve Bank of Australia is not going to move rates for at least 6 months, right? If this data is really strong or really disappointed, it will force the hand of the Reserve Bank of Australia one way or the other, and therefore result in strong moves in the Aussie dollar overnight. Okay, we have in Europe markets and service CPIs. Sorry, manufacturing PMIs. Sorry, no CPIs. I was thinking of today inflation PMIs. Honestly, I'm not expecting big shocks from this readings. What I'm seeing lately is that the market is reacting less to this data because the euro area is steadily in grow region above 50. Marks remain above 50, hovering a bit higher, a bit lower, but nothing really impressive. So we have grow in the region, moderate, slow, but grow, right? So market's reactions to these numbers are less relevant than what we have, I don't know, a year ago. Okay, then I believe that anyway, the attention will come into the Bank of England. No changes are expected. In fact, I do believe that we are going to have another day of hawkish carnage, right? So keep that in mind. If Of course, it will depend on how the Fed acts on Wednesday, but I do believe that the hawkish carney and no changes in here will be slightly supportive of the pound because that's what we got last month, and we're going to see not much big changes in the Bank of England stance. Okay, inflation in the US after the Fed. Not sure if it's going to be so much of a big market mover, right? If it's going to hit us bad, but of course, if we saw a nice uptick in inflation readings, hope of a faster pace of hikes next year will be revived, and therefore the market will probably run into the greenback again. That will happen only if the Fed actually rises rates, right? Because if the Fed stands on hold, uh, this data, no matter how positive it is, it won't help the greenback. Okay, market will be disappointed if the Fed stays on hold. And as I said at the beginning, the Fed will start losing credibility. Okay, Inflation in Europe on Friday is for me probably the most relevant report, but again, not expecting a big shock in here. Minus 0.1% monthly basis, 0.2, 0.1, 0.8. We are too far away from that just under below 2% target of Draghi. And we are not going to see any big surprise in here that could be euro supportive. Um, about the euro dollar bearish case, of course, much of what it's going on in the market these days, it's about the Fed and the ECB. And the fact is that the imbalance between both central banks is likely to be more highlighted, right, by the Fed. Uh, so there's not much support in a bullish case for the pair. I don't know. I'm not those that can see long term and think about the pair plummeting to parity. I can talk about parity these days, but I can see the pair approaching close to the level if the greenback remains strong and the Fed is far more hawkish than what market is actually expecting. Anyway, this is the euro dollar for our charts. And as you can see, the pair has a attempt to regain ground with the ECB, but of course, the aftermarket read read more clearly what Draghi offered the market, and it was a larger stimulus than was initially estimated because he reduced the monthly amounts but extended for 9 months instead of six. Right, was quickly reverted. Anyway, we're standing close to that 504 low we have this December. I will change to my monthly charts and you will see that we have bottom around the same level next past December 520 on November. Uh, we had this low of 519 on April and the low of 2015, which was over 12 years low at 416, right? So it's a big hard, a big, uh, huge support area. The euro has between 460 and 520. I do believe that if somehow tomorrow we break below 500, we are going to see a quick slide to that 416, and that with an initial impulse, the pair can break below, but beware that it can bounce from, I don't know, maybe 450, 460, 440, right? Break below 460, a couple of pips, then come back. But if that comeback remains limited below 520, right, chances are of fresh low and a final breakout of that 416, which could say the pair tomorrow towards 400, but favor another 200 pips decline. 1.02 is my today's target in the case of a clear dollar strength. Okay, towards the upside, I was watching that the pair seems unable to regain this 100 simple moving average in the 4-hour charts. This is really short term, but I believe that the key resistance comes here at 690, the 23.6% retracement of the latest bearish move. So I would love to see the PR regaining this level and probably heading up to 800, 810. We have little in the way near, but that should be a huge disappointment from the Fed. Anyway, 804, 800, 840, 850 is major resistance level, and I would like to see a pair closing the week above that level to deny the possibility of downward extension and see it recovering further, maybe to 110 in the coming weeks, but not in the short term. And when it comes to the British pound, against the greenback, of course, this is the softer Brexit rally, as I call it, right? This is the gains trigger after market knew there was a chance to avoid hard Brexit. So here we are, last week, helped by poor UK data and the ECB decision. the pair plummet, but bottom around above 61.6%, 61.8% retracement of such rally between there and the 50%, and it remains stuck. And all of a sudden, we are back above the 23.6% of a rally around 2680, right? So I could expect further gains in the pound today, probably up to 2770 the most, okay, but not much more, okay. And of course, who knows what will happen tomorrow, right? But anyway, I do believe that downward potential is way limited, and whether the Fed acts or not, the decline in year would be far more limited than the one we could see in the euro. Anyway, 26.25 is the immediate support. Okay, uh, below that level, we can go down to 25 region, and below that, and I do not see much of a bearish potential because we have this daily ascendant trend line coming from December low, capping downside. And towards the upside, I was watching this low around 2793, which is July monthly low. For me, that's the line in the sun. We have in here another high daily basis, a couple of highs daily basis in the region. So we need to regain that level to talk about bullish extension in the pound for whatever reason up to 2860 first. And if somehow we close the day above that level, I do believe that there's scope for an upward extension up to 113. Okay, give me a second. Sorry, sorry for the interruption, guys. Anyway, let's jump to the dollar Japanese yen, right? Here we are. There's so much to say about this pair. The fact is that it's currently trading at levels last seen in February. And if you take a look at the weekly chart, right, it has been up for 5 weeks straight in a row, broke above the 100 simple moving average in the weekly, broke above that 23.6% retracement of 2011 2015 rally. So it's overall bullish, right? But of course, it's all about the Fed helping the pair, of course, advance our higher stocks. We have US stocks reaching record heights, and of course, yields differentials. I'm pretty sure that the Bank of Japan will have to uh, intervene to curve yields sooner than expected, particularly if the Fed rise rates. Okay, because rates in years are really bonds rates, sorry, yields of bonds are running to historical highs. Anyway, from a technical point of view, the main support in here for me is the 14 region. Okay, and of course, above 116, I do believe that the pair has scope to move up to 1660. We have really relevant heights and lows in the region. Not seeing much of an upward scope above that level right now, but a break above it will probably result in a rally up to 118 over the upcoming days. It's all about the Fed. I really feel ashamed of repeating those words, but that's what it is in the market, guys. Anyway, below 14, I do believe that there's not much in the way until 13 or 113, I mean. And for me, 112.80 is the line in the sun. If somehow the pair breaks below that level, there's scope for a steeper decline down towards the 110 region. And in the case, we don't have much action coming from the Fed. Anyway, and for the Australian dollar, the fact is that beer has been lacking direction ever since late November. We have been hovering up around the 74.50 region with a slightly bullish tone. I have drawn this trend line to mark how the pair is making higher lows, but at the same time, there's a huge barrier around 75. We have tested the level, the region multiple times uh, over the past 3 weeks, and the pair was quickly reversed. So there's nothing, not much of a trend going on in here, not much to say. Honestly, I'm thinking right now on a break above 75.13 to talk about the mapware extension. I then will be targeting the 0.76 price zone, right, which is the major Fibonacci resistance, and where the pair has also shown the behavior similar to this one, reaching that level and consolidating around it. Towards the downside, I do believe that this lows around 74.10, which is slightly below the trend line, are the level to watch. If the pair breaks below it, there's a good chance that it may fall down to 73, 73.30. But I'm still not convinced that the pair will be on a bearish breakout. I can't see the OC breaking below 0.70, guys. Uh, I can't. I do believe that. Yeah, think about this. If the Fed rises rates and send them to 0.50, 0.75, it still will be half the 1.5% record low Australia has. So rate differentials will keep on favoring the OCs. In this particular case, rates are not as relevant as it could be against European or Japanese ones that are in negative territory. Okay. And finally, let's talk a bit about gold. As you can see, the commodity is developing within a bearish channel in the short term. It has accelerated its decline ever since Trump won the elections. It's trading at multi-month lows. As I said, remember that the production cost is 1,100, around that level, 1,000. So, as we mentioned multiple times over the past 2 weeks, the commodity is bearish, but the bearish momentum is decelerating because there's not much more room to the downside. Still, that does not mean that we can see a huge downward move tomorrow, but I'm not sure if it will be able to hold below 1100. Okay, guys? So beware of that. Take profits out of the table if you're shorting gold after the Fed and make money, because I'm not sure how much it can stand at these levels. And you know what happens? We are waiting for a big event in the market. The event takes place, and once that settles a few hours after the event, maybe 2 days after the event, the market shifts its attentions towards something else, right? And all what we were reading in the market, it gets changed, right? So keep that in mind. Anyway, short term, we are pretty bearish. We have a weekly low so far around 51. I do believe that we have a stronger support around 1140 to 80. That's a strong support for me. And below that level, the commodity can shed some other $20 with not much in the way. Okay. For tomorrow, the roof of the channel stands around 1167, 1168, right? It's for tomorrow, I'm calculating. So I could say that some follow through below 1170 would probably open doors for an upward extension, and we may see the commodity uh, approaching 1200, right? If the Fed stands on hold, movements will be much more interesting to the upside in gold if the Fed stays on hold than any kind of bearish extension we may have if the Fed actually acts. Okay. Anyway, sorry. That's it for today, guys. Hope it's useful. Hope you can make money tomorrow. And I'm going to cover it live with your high as usual. So thank you, and see you back tomorrow afternoon. Okay. Thank you. Bye bye.